Business combinations under IFRS accounting standards require identifiable assets, liabilities, and consideration transferred to be measured at fair value at the acquisition date. This principle ensures that consolidated financial statements reflect the economic substance of the transaction and provide transparent information regarding the resources acquired and obligations assumed. Fair value measurement is necessary because the historical carrying amounts recorded in the subsidiary's own financial statements may not represent current market values. Measuring both consideration and net identifiable assets at fair value allows accurate calculation of goodwill or gain on bargain purchase. This approach improves comparability, reliability, and faithful representation by ensuring that acquisition accounting reflects the true economic value exchanged between the acquiring entity and the acquired business. The fair value of consideration transferred in a business combination may consist of several components, each requiring separate measurement. Cash consideration is measured at the amount paid at acquisition date. Share exchanges are measured using the fair value of shares issued by the acquirer, usually based on market prices at acquisition date. Deferred consideration involves future payments and must be discounted to present value because settlement occurs after acquisition. Contingent consideration depends on future events or performance targets and is recognized initially at fair value regardless of probability. Subsequent changes in contingent consideration may affect profit or loss depending on classification. Proper measurement of all consideration components is essential because they directly influence acquisition accounting, consolidated goodwill, and future financial reporting outcomes. Goodwill arises when the fair value of consideration transferred, together with non-controlling interests and previously held interests where applicable, exceeds the fair value of identifiable net assets acquired. Goodwill represents future economic benefits arising from synergies, customer relationships, market position, or other advantages not separately identifiable. Conversely, if identifiable net assets exceed consideration transferred, a gain on bargain purchase is recognized in profit or loss after reassessment of measurements. Accurate fair value adjustments are therefore critical because errors in valuing assets, liabilities, or consideration directly affect reported goodwill and future impairment assessments. Consolidated financial statements must incorporate these fair value adjustments to ensure that group assets and liabilities reflect acquisition date economic values consistently and transparently. Fair value adjustments commonly arise for non-current assets such as property, plant, equipment, and intangible assets. Depreciating assets acquired in a business combination may have fair values differing from their carrying amounts in subsidiary accounts, requiring adjustment during consolidation. Subsequent depreciation must then be based on the revised fair values and remaining useful lives. Non-depreciating assets such as land are also adjusted to fair value but do not require depreciation adjustments. Inventory may similarly require fair value adjustments if market selling prices exceed recorded cost values at acquisition date. These adjustments increase the accuracy of consolidated financial statements by ensuring that acquired assets are reported at amounts reflecting current economic conditions rather than outdated historical carrying amounts. Deferred tax implications often arise from fair value adjustments because tax authorities may continue recognizing original tax bases while accounting records reflect fair value increases or decreases. Temporary differences between fair values and tax bases therefore create deferred tax assets or liabilities under IAS 12 income taxes. These deferred tax effects must be recognized during acquisition accounting because they influence the fair value of identifiable net assets acquired and consequently affect goodwill calculations. In addition, liabilities and previously unrecognized assets, including contingent liabilities and certain intangible assets, may need recognition at fair value during consolidation even if absent from the subsidiary's individual financial statements. This comprehensive recognition approach ensures complete and faithful representation of acquired economic resources and obligations within consolidated reporting. Contingent liabilities acquired in business combinations are recognized at fair value if they represent present obligations arising from past events and can be measured reliably, even when outflows are not probable under IAS 37. Similarly, identifiable intangible assets not previously recognized by the subsidiary, such as customer relationships, brands, or licenses, may require recognition if separable or arising from contractual rights. These adjustments broaden the scope of assets and liabilities included in consolidated financial statements beyond amounts previously recognized by the subsidiary. Accurate identification and valuation of such items improve transparency and provide users with a more complete understanding of the economic effects of acquisitions, future risks, and intangible resources contributing to group value and future profitability. Overall, Fair value adjustments in business combinations are fundamental to accurate acquisition accounting and consolidated financial reporting under IFRS accounting standards. Measuring consideration transferred and identifiable assets and liabilities at fair value ensures that consolidated statements reflect economic substance and current market conditions rather than historical carrying amounts. Adjustments involving non-current assets, inventory, deferred tax, liabilities, and previously unrecognized assets directly affect goodwill calculations, future depreciation, profitability, and financial position. The recognition of contingent liabilities and intangible assets further strengthens transparency and completeness within group reporting. For DIP IFR candidates, understanding fair value adjustments is essential because acquisition accounting represents one of the most technically demanding and strategically significant areas of international financial reporting and corporate consolidation practice.